I do talk to financial advisors a lot, especially the white paper. I've been getting calls or emails about diversification versus hedging. And what they're saying to me is, I don't want to be in bonds, but I don't know where else to be. Or if they are in bonds, they're in short-term bonds, Carlisle. And I read your article on using protection and insurance and protective puts, and I found it interesting. And so these are the conversations I've had recently. But I've been asking, I say, well, what are you doing right now? And this is the list that I got. I would say this is the most popular list that I got of people that have called me and I've talked to advisors. And I found it interesting. Private equity has gotten popular. It's just giving your money to an entity that's a private company that has a business idea. And hopefully they do well, but if they don't, your money's locked up, and if they go out of business, you lose all your lump money. I've never been a fan of private equity, not that you can't do well, but it's just not public. You can't just say, this is a dog I'm getting out. It's locked in. So not a big fan of private equity. Cryptocurrency, I think it's fine, but it's speculation. It's go to Las Vegas. More diversification doesn't make a lot of sense to me. I teach a class at CU called Hedging Commodities and Financial Markets. Commodities are going stupid right now because of the bottleneck, because people, the housing market, there's not enough lumber, there's not enough copper, and so there's a shipping problem, the same problem with microchips. So I love these last two. I've been in this business too long, I really have. Because buy the dip, I love this one. Do you realize that the average, I looked at the statistics, the average financial planner was in high school during the credit crisis, was in high school. Now, I was not in high school. I wish I was, but I was not. But the point I'm trying to make, so the average financial planner doesn't know what a down market is. All they know is, hey, Dom, I just buy the dip, okay? And it's worked, and I've made my clients rich, and I manage billions of dollars. And even COVID, just buy the dip. But then I say, and I wrote an article, I said, yeah, but I remember in 2000 to 2003, if you'd have bought the dip, you'd have been homeless by 2003. Those who do not study the past are doomed to repeat it. So it's like, yeah, it's worked since 2009, but we go through one of these and buying the dip and your clients are going to be suing you. So I don't think that's a strategy. The other strategy is the markets always go up. Well, we know that's true because you guys have seen this chart. And remember, this is the stock market, but it's at $1913. If I adjust the stock market to today's dollars, it looks more like that. And there's time periods when the market's been done very well. And then there's time periods where we had stagflation, and that was the price controls, Nixon, OPEC was squeezing us, and we had stagflation.